during this afternoon, what we'll be sharing with you and going into particular detail with is raising finance via crowdfunding and also debt funding. They're the key two areas that we'll be talking about today. We've got alongside with us today Pollyanna Hall, who will be presenting an overview of crowdfunding. She is our crowdfunding expert. And then we've got Alex Beardsley from ABL, who will be discussing debt funding. So just before we begin, I just wanted to share with you a little bit about FDS. So FDS, we've been established for over 30 years. We are an employee ownership company. We turned into an employee ownership company last year. We're an award-winning corporate finance firm, and our specialism is owner-managed businesses. That's who we work with day in, day out, working towards a successful exit and working with owner managers, getting them through their business journey and supporting them at every stage. So we're going to start, like I said, with Polly, who will now start with crowdfunding. Polly?
Thanks. Hi, everyone. So as Pino said, my name is Polly, and I'm going to give you a bit of a whistle-stop tour on how crowdfunding works and how it might work for your business. But first, I guess I just want to give you a little bit on the history of crowdfunding. So crowdfunding has become has received a lot more interest recently, obviously due to the pandemic that we're finding ourselves in. So whereas I think traditionally crowdfunding has really been viewed as something for a startup or for a company that's looking to make a major change in its business, crowdfunding more and more is being used by really established businesses to help them grow their base of fans through the way that crowdfunding works and how you get lots of different people that gain an interest in your business, but also just as an alternative to really traditional funding. So it's been established for about 10 years. There are over 600 sites. So there'll be some really household names that you'll know, things like Seeders and Crowdcube, but there are also lots of really specialist sites that are tailored towards certain businesses and industries. So whether that's B2B or B2C, and there are businesses that allow for international investments, and there are also platforms that allow for international investments, and also platforms that allow you to target your really local community. So it's got a really diverse offering. The beauty of crowdfunding is that you are able to reach a huge array of people. So whereas with traditional funding, you might be speaking to a VC or a single angel and might get some real worth out of that relationship. One of the great things about crowdfunding is that you've got people who are investing everything from £10 all the way through to tens of thousands of pounds. So you have a range of sophisticated and unsophisticated investors. And what that means is it's an opportunity to build your brand with potentially the end consumer. So it doesn't matter whether your business is a B2B service or a B2C service or an actual product. You're able to speak to people who might be able to then help your business grow, not just from this investment, but also later want to work with your business. So in many ways, crowdfunding is actually an opportunity to either start or restart your marketing with a totally different approach. Then often, I know one of the other great things about crowdfunding is that, as we know in business, when you're looking to funding, you might need a certain amount of funding at a particular time, but a few months down the line, a year down the line, you might need to go back to that VC or the bank and say, actually, I want to do some more money to do this next project. The great thing about crowdfunding and crowdfunding sites is they are geared up to allow you to do this. And this is what businesses like Revolt, Monzo Bank, Brewdog have done so well, because what crowdfunding does is it builds this community of people who have a vested interest in seeing your business succeed because they're already shareholders, or because your raise was so successful already, there are people who potentially missed it and have seen it since in the press. So it's really geared up to help your business continue to grow and continue to see this swell of a tribe of people who are just desperate to make your business go. And then each time they do, obviously, you get the chance to go back to that, and it's another brand building opportunity. So there are different types of crowdfunding. I'm going to speak specifically about equity today because equity is probably the most complex, but there are lots of other types. So there's things like donation, which are things like just giving. So I'm sure everyone has come across that. So that's typically for charities or for individuals raising money for charity. So it isn't relevant to a lot of the businesses that we speak to. And then there's things like reward, which are things like Kickstarter and Indiegogo. So that's two of the really big reward platforms. And that's where in return for money for your business, you give a product. Now they actually have some quite strict rules about the sort of products that they will take on their platform. It has to be a really new product to market. It has to be really innovative. It has to be seen to be something that would disturb the market. You can put other things on there. I've worked with companies who have built attractions and have sold tickets, but it's quite a complicated one to navigate. Debt funding is exactly what it sounds like. Alex is going to cover that as well. Sometimes it's secured, sometimes it's unsecured. And then equity is where in return for an investment in your business, you give shares away in your business. And as I said earlier, within all of these sites, there are then specialist sites. So you might be thinking, oh, well, actually, I'm gonna do something on Crowdcube. But if you're in a specific industry, Crowdcube might not actually allow you on their platform. So for example, if you're in property, you can't go on a mainstream site. And if you're in B2B or tech, these sites all have different benefits in terms of the sort of things they raise for. So it's really important to choose the right site for your organization. So this is a really simple flow diagram of the process of crowdfunding. So I think there's a real misconception that with crowdfunding, you create a PowerPoint about your business, maybe create a quick video and you shove it up and loads of people give you loads of money. And actually the process is quite a bit more complicated than that. So it begins with a business valuation. So we've all seen Dragon's Den. We've all seen where someone goes in and says, I want £250,000 for a 5% stake in my business, and the dragons say, don't be so ridiculous, your business is never going to make that much money. So a business valuation allows you to show that you have really taken seriously how much your business is worth, and also protects you as the owner from not giving away too much equity. So our partners at various sites say to us, actually one of the biggest reasons that people don't fund is they have over-egged the value of their business. Then we would always recommend that you have a business plan, and that becomes really important for point 3. So your business plan is obviously the story of your business, what you're going to do next, how you're going to use the investment. But you really need that for what's called a cornerstone investor. So in equity crowdfunding, you have to have an investment of 20% of your total raise. So if that was £1 million, it'd be £200,000. And that typically comes from one or maybe a few individuals. Now, those sorts of individuals are investing quite a bit more money than the MAR and PAR investors I talked about earlier. So they're going to want to know that you have done your homework, and that business plan is used to secure that cornerstone investor. Then you need some documents for the platform itself. So that's the pitch document, the video. You're in a really competitive space. There are lots of other people bidding for money, so you need to make sure that your work stands out. That then has to go through an approval process within the platform. And then you go into pitch promotion, which I'm going to come on to, which is effectively marketing your business for investment. Then most of the sites have what is called a private launch, and we would always recommend taking advantage of a private launch. That's where you can invite friends and family, your neighbor, people that you trust, or people that it could be customers of your business who have expressed an interest in investing but couldn't be the cornerstone. You invite them to invest before it goes live on the platform. And what that then means is when it moves on to point 8, which is the public launch, you go live showing that you've already funded a certain amount. And because of how the algorithms of the sites work, it goes, gosh, this business is already doing well. They've funded 70% and they've only just gone live. So it's a really clever bit of marketing. Then obviously, hopefully you're fully funded. All of the sites have what's called a winner takes all model. So if you're wanting to raise £1 million and you don't quite hit it by 3 or 4 pence, you don't get anything. So we'll come on to raise strategies in a minute. But if you're fully funded, you complete that round and then the money goes in the bank, and then you have ongoing interaction with your funders, so your new fan base. So this is a quote from one of our colleagues at Crowdcube, and it says, promoting your pitch is probably the most important aspect of crowdfunding. And it's one of the pieces that is most likely to be forgotten, which is that in going on crowdfunding, you are effectively marketing your business for an investment. So that is like any other marketing plan. You're taking a customer from awareness through to loyalty. But unlike a traditional marketing campaign where you might have, half a year, 3 months, potentially even longer, you've got to do it within 30 days. And in some cases, you're taking people who have never heard of crowdfunding, explaining what crowdfunding is, explaining why your business is the investment, and getting them to invest. And there is a sign-up process for most of these sites. For some cases, you're taking people who've never heard of your business, but are maybe serial crowdfunders and invest in lots of different businesses, and explaining why you're better than all of the other funky businesses that are on there. So initially you have to decide what you want your investors to think, how you want them to behave, and then decide what tools you've got in your armory already, or what tools you need to create prior to going live on the platform, to make sure that you're going to gain enough interest. So that might be social media, it might be email, it might be telephone, cold calls. Your business will be unique, and that's something that we would be able to help you work through. But some really key pieces of advice for anyone thinking about this. So the first piece is promote early. You have 30 days to get your full investment. If you start on day one, you will not fund, because it is a huge decision for some people, especially people who haven't heard of crowdfunding, to make an investment in a business. There's quite a bit of explanation that needs to be done. And for people who are serial investors, the competition is really stiff. So start early. Remember that lots of deals will happen offline. Not all deals will happen on the platform. So you can still have those really traditional fundraising conversations with your colleagues, your clients, whoever. But don't just think because you've got the platform behind you that suddenly you will fund. Remember that you are promoting your business as the investment. Yes, you might have a product or a service which is great to sell, but actually people are investing because they believe that your business is going to succeed and ultimately make them some money in the long or short term. This is potentially your first opportunity to market, but if not your first opportunity, it's a real opportunity to market to a huge base of people. So don't waste it by talking about the wrong thing. And then there are 3 really key things that you need to think about with crowdfunding. We always say you have to talk to the head, the heart, and the little kid. So speaking to the head is this business going to make money? Is it going to be successful? Is it going to give me a return on my investment? And that is something which comes out through the pitch deck, through your video. You need to make sure that your business is financially viable. And then the heart is, does your business do something good? Because you're often talking to an end consumer, these unsophisticated ma and pa investors, it might be that you do a corporate away day where you volunteer for 5 days a year. It might be that you are a carbon neutral business. It might be that your business actually is fundamentally good and you do something that puts something great back in the world. It might be that at the moment you don't have something like that, and that might be something that we need to work with you on in your business plan to say, what do people feel good about when they think about your business? And then the little kid is fundamentally, is your business fun? Is it exciting? And is it cool? And you might be thinking, well, I'm not sure my business is cool, but we have worked with a huge array of businesses, everyone from really funky fintech to some really random industries. And there is always something exciting to be found. It's just about teasing that out and then making sure that people understand why that is unique within your sector and why they should be excited about it. And then the final thing, which is probably always one of the the things that people don't like, is that you're going to need a bit of money to market this pitch. No marketing that's really impactful is free. So it might not be that you might not need £10,000, but you're going to need a little bit of cash just to give this a bit of a boost, unless you already have an enormous customer base who are likely to invest. Okay. So finally, or almost finally, I should say, just some key things to think about when you're going on your crowdfunding journey. So the first is your approach to your raise. So as I said earlier, a lot of these platforms are winner take all platforms. And that means that if you miss your funding target by 3 pence, you won't get a penny. So all of that hard work, all of that time and investment will be gone. And you might be able to go back to the platform in a few years' time or even in a few months' time, but it's not an ideal situation to be in. So what we always recommend is thinking about, if you want to raise £1 million, what is the least amount of money you could do whatever it is you're wanting to do with? So maybe it's a piece of new tech that you could put into phases rather than doing it all at once. Maybe you could just do the technical build and not fund for the marketing activity you want to do for that. But we would always initially say fund for the littlest, because actually you still might raise the full £1 million, which is brilliant. But if you can say I'm going to raise 500,000 and then you raise £1 million, that's great, because then you're going to get to keep it all. If you say I need £1 million and you raise 900,000, you're not going to get anything. So part of what we recommend is this, what we call a stretch raise approach, and we work with you to be able to say, brilliant funders, we've already funded 100%. If we fund another 50%, this is what we're going to do with it. So you're not suddenly going, oh gosh, that's great, I've got a load of money and now I need to think about what I'd do if I got some more. It's about being really prepared and timely, because you've got this 30-day really important window. The other thing to think about is that you're going to have a community of people that you need to maintain along the crowdfunding journey, but also afterwards. So most of the platforms have tools that make it really easy to communicate with your investors. So you're not going to have a relationship with, 1,000, 100,000 people. It's not going to look messy on Companies House or anything like that. It's all handled through one platform, but you do need to think about what you're going to say to them. How much are you going to keep them informed? Are you going to send them your annual accounts, or are you just going to send them, are you going to have an AGM where you invite them? All things just to be thinking about. It's not difficult, and please don't be scared by the idea of having all these investors, because the platforms make it really easy for you. But what's great about having all these people is you have this really loyal community of fans. So the research that's done by some of the platforms tell us that people who are invested in your business are 400% more likely to either use you or recommend you. And I don't think there is any business in the world who couldn't have a group of people who are more likely to recommend you. So what a brilliant opportunity to get these fans to be part of your marketing. It gives you a totally different approach to your business. And then finally, the last thing I said a little bit about earlier is this idea of future raises. So being able to go back and back and back to the community, be that people who have already invested, or be that the actual platform itself, and say, we're going to do this really exciting thing now. We'd love you to invest more. It's just this almost ready bank of people who are like, yeah, I know what your business does and it's great, and I want to be part of it even more. So I guess to summarize that whistle stop tour, one size does not fit all. One site doesn't fit every business. It might be that actually you need to raise a really significant amount of money, and these sites will raise 15 million for businesses, if not more, in one fundraise. So don't be afraid if it is a big raise that you need to do, but one size isn't necessarily right for every business. So it might be that what we recommend for you is a syndicated funding option. Part of what we do is support you through the whole journey, so you can be as involved in the process as you want to be. On crowdfunding, people definitely invest in the entrepreneur as much as they do in the business. So it's really important that you are still very much involved and excited about the process. But if you don't want to answer your own queries within the crowdfunding stage, that's fine. If you don't want to do your own social media throughout that stage, that's fine. That is part of what we've put together, this turnkey solution. So crowdfunding is a really exciting way to grow your business, not just from a financial perspective, but also from a marketing and fan perspective. So that's it for me. I'm going to hand over to Alex to talk a bit more about other funding options. But if you have any questions, just bob them on the comments and I'm sure we'll be able to answer them.
Thank you so much, Polly. I think that's been really useful just to get that overview of crowdfunding. And please, like Polly just mentioned, if you've got any questions, pop them along in the chat box and we'll try and answer them as we go along. There will be a Q&A session at the end as well. So whatever suits everybody, that'll be great. Alex, do you want to start on the debt funding slides?
Absolutely. Thank you very much. And thank you, Polly. So I'm going to talk today to give you a little bit of a snapshot about the UK debt funding environment, because crowdfunding might not be for everybody, and this webinar is about how to raise funds for your business right now. So the UK lending market at the minute, we're seeing a real increase in the number of mergers and acquisitions, but also we're seeing that COVID lending, the stimulus from government has gone through the roof. And with all of this, with appetite being high, but also all of this lending going out to businesses, you could be forgiven for thinking that debt is really dead at the minute, but it's not. It's about knowing the right places in which to find that debt, and there are money out there for businesses to continue to trade, grow, and also acquire other businesses. and I'm going to explain what that is today. Thanks, Rachel. So what's next for UK finance? So there's a bit of a challenge that the UK finance industry have at the minute, with CBILS due to end on the 31st of March and the Pay As You Grow bounce back loan scheme just being announced. There's still a long way that the government need to go, or the UK finance market need to go, to be able to support the cash flow pressures that some businesses have and manage debt effectively, but also at the same time support growth of businesses, because there's a real swing of businesses that have had either done really, really well throughout the pandemic or have done really, really badly. And that's all about supply chains. There's no real clear industry or sector which has suffered. And whilst the bounce back loans gave initially £50,000, and the Pay As You Grow, will help them pay back over a longer period of time, the CBILS facilities have actually started to have a negative impact on those businesses that they really need to help, because the general funding market, if you're looking at unsecured lending, has stopped lending altogether, and they're just doing CBILS facilities. So a lot hangs on the budget on the 3rd of March and what is coming up next for the UK finance market in terms of future lending to support that growth. We are seeing a lot of businesses, a lot of lending institutions at the minute looking at calculations such as earnings before interest, tax, depreciation, amortisation and COVID. So taking into account the impact that COVID has actually had on the business, both positive and negative, when looking at whether or not they're looking to lend to that business on a debt perspective. And from the Finance Act 2020, there was a HMRC preferential creditor status that was introduced, and that was from the 1st of December 2020, and that means that more often now lenders are looking at the current HMRC position with businesses. So have you paid your PAYE, have you paid your tax, even if you've taken a deferment. We are starting to see come through businesses that have taken a deferment which they were absolutely entitled to take, now being pushed back on lending from a serviceability point of view, because they now need to make that payment. So all of these things need to be taken into consideration if you are looking for funding. Really understand what your position is, including the impact from COVID and also your HMRC position. But don't forget that up until the 31st of March, and it may be extended, may CBILS, but there is an opportunity for businesses there to get as much as they can really out of the CBILS facilities, because you can do it across loans, commercial property, invoice finance. Make sure that you have explored all of those areas before the 31st of March to make sure that you're not stopping the ability of you getting finance post that date, should there be nothing else in the pipeline to lend to SMEs that have a lot of debt within the business, or that just don't meet the criteria that lenders are looking for post the CBILS ending. Thanks, Rachel. So what finance is required currently, and where can businesses find it? So as I just discussed, the UK lending landscape has changed and is changing. Previously, prior to COVID, it was very, very simple for a business to go online. If you're looking at sub £250,000, you could go online, you could input your details into a fintech platform like a Compare the Market for commercial lending, and it would spit out lenders that would potentially offer you finance. Throughout COVID, the fintech platforms have really been kind of unplugged, because the algorithms that they were written for, all the finance companies that they had on their platform, have switched all over to CBILS. And looking at these calculations in terms of what the COVID impact is, assessing viability, understanding serviceability, it's going to be a little bit more difficult for businesses to actually raise finance, because there's a bit more that needs to go into it. But we're seeing a lot of businesses looking at restructuring their finances or needing finance for working capital or growth. And the banks are still available, the banks are still there, and they are still lending, albeit to a lower loan to value. So whilst banks will have traditionally been and will always be the most cost-effective way of raising funds, on the other hand, they also have the least risk appetite. So there's going to be a lot of riskier businesses classed after this pandemic. So the bank may not always be the best place to go. But challenger banks have been really, really to the forefront in lending CBILS and also through in the mergers and acquisitions space. They understand the commercial environment, they understand commercial lending, and also they will take a view on businesses from a commercial perspective, and they're not as risk averse, although it will cost you a little bit more, but actually they may give you more flexibility. Now, we're seeing a rise in specific funds, so venture capital debt funds that are looking sub $500,000 lend for high growth, commercially viable businesses. Now, there's a lot of financial due diligence that goes into this in order to assess whether or not they will lend. However, they are quite advantageous in terms of being non-debenture led, no personal guarantees. So that's an option there for businesses that are looking at raising funds for acquisition, merger, or for growth capital, really high growth projects. Now, what we're seeing is that whereas previously we would have always looked for businesses to take out longer term debt funds, which would provide asset-based lending that would provide revolving credit on an ongoing basis, or commercial mortgages where the businesses knew over a long period what their repayments were. We are actually thinking at the minute that businesses should look at the benefits of taking out short-term lending for now until the market picks up again or stabilises. Just to give you an example, that commercial mortgages at the minute, you're looking at rates of like 6.99%, and then there's high early repayment charges if you come out of that commercial mortgage within 5 years. So maybe if you're looking at something like that at the minute, just assess what would be the cost of you using a bridging facility or something on a more shorter term that you have no early repayment charges, so that when the commercial market picks back up again, you can then refinance it onto a longer term. And it's just really trying to make businesses aware that there are options out there. The bank is not just the option, the challenger bank is not just an option, or the venture debt capital business is not an option. There's lots of options. So make sure that you are aware of all of your options before you go into any funding at the minute, because then at least you've made an informed decision. You've not just taken the first thing that comes on your desk and you think, actually, that'll solve the problem, because I can guarantee that there's more than one way to solve whichever debt funding problem you have. So nicely segueing into, that's obviously what we do. We work with business owners and their advisors to find access to finance, and we have access to the whole of the market. We can use multiple funders as required. We're fully FCA authorised, and we provide finance for businesses, not just for the lenders. So it's about making sure that the finance that's put into the business works for the business and not just the lender that you've been put in touch with. And that's all from me. If anybody has any questions, either put them in the chat or ask me at the end. Thank you.
Thank you so much, Alex. I really appreciate that feedback. And, you know, I can vouch that Alex has helped many of our clients to just really work through all the options and what is the financial viable option for our client, what is the best option. So, you know, Alex takes that heavy lifting of going through all that information quite promptly, actually, to come back to you with options quite quickly. So the next section that we're just going to touch upon is the importance of a robust valuation and business plan. Now, as Polly and Alex have both mentioned, when we're looking at doing any crowdfunding or requiring any equity finance, it's really important that we do have a robust valuation. And at FDS, what we do is we produce evaluations based on real-time deal data. So we compare it to deals that have happened and compare what the multiples have been achieved in that sector. And we also ensure that it's fully researched, transparent, and in detail. And we've done valuations for a number of reasons, but you know, our valuations are very robust because that's what will really help with the process in terms of when we are in front of any investors, whether that's Cornerstone or Mar and Par investors. we are able to demonstrate how we have reached such a valuation. From a debt funding perspective, it's really important for Alex and her team to also have a robust business plan, and that's also required in crowdfunding too. So for crowdfunding, when we're going out for this initial 20% that we need before we can get onto the platform, we're in front of sophisticated investors. And when we're in front of sophisticated investors, again, like Polly had demonstrated, on a platform, you need to have a really important pitch document that really stands out from the rest. And it's the same with sophisticated investors. That's what they do on a day-to-day basis. We need to ensure what we put in front of them, they see that, and it's quite clear whether that's an investment for them or not. And as I explained right at the beginning, we've dealt with over 400 plus transactions. We've got a list of 600 plus referrer contacts, which include high net worths, and we can help on that journey in terms of securing that a cornerstone investor. And for debt funding, again, the banks want to know that you're able to repay those funds back, so or any type of funder. So it's really important when we're looking at a business plan, it's not just talking about the historical efforts that business has done, but what are the future opportunities? And we need to, rather than just sell the sausage, we need to sell the sizzle and really display that in front of all the funders to make sure that we can get the investment that you need.